What does inflation do to cause mortgage interest rates to go up and down and fluctuate so much? Today we're going to snap into that video. Stay tuned. Hey, Glenda White here with Verity Mortgage, the mortgage coach, DFW. We're here each and every week to help our community grow. We're talking how to build a real estate plan, how to leverage your income, your finances, your assets, and really talk real estate and, of course, generational wealth. So we're so glad to have you back each and every week as we talk different about what's going on in the marketplace, real estate, mortgages, and, of course, our beloved Cowboys. So if this is the first time that you've joined us, welcome, welcome, welcome. It's freezing here in Dallas, so here we go. And if you're back, we're so glad to have you. If you or a family member or friend are looking to refinance or make that home purchase, go ahead and share this community with them. We love the support. We love the growing factors that we have. Before further ado, let's jump in it. All right, Glenda, so what is inflation, right? Inflation is what it costs today to get a goods and services versus what it did 12 months ago. So inflation is the price of an increase over that goods and services. Now, what does the inflation rate and mortgage rate have to do with each other? Do they actually tie into each other? No, but they do work tandem with each other. So remember, inflation rates are set by the Federal Reserve, which is the central bank of the United States government. And they monitor the cost of that goods and services with key performance indicators over a span of time. And when the inflation and the cost of the dollar changes so much, then the price of inflation goes up, right? So let's think about bacon. I love bacon. Bacon sounds good to me today, but bacon has risen 19.3%. Yeah, that's right. So do the math. When we were looking at bacon a couple months ago, it was $6 a pound. Well, when you actually look at it today, yesterday, it was almost $14. So that is a huge price of a spike of bacon, which is crazy. I don't know why bacon's set, but anyway, side note. So what does this mean, right? Typically, the Federal Reserve likes to see a 2% increase, so the volatility of the market going up and down. When inflation rates are so high on goods and services, what has caused it? So we look back, and then, of course, we look forward as well. So what has happened over the last 2 years? Of course, the pandemic. We had boats in the middle of the Suez Canal that couldn't get anywhere. We've got boats on the other side of the ocean that can't go anywhere because simply there's not enough supply, but there's an over demand for these factors, right? How many times have you gone to the grocery store and needed something but can't find it? I'll tell you right now, I'm trying to find cream cheese. I can't find it anywhere. So if you have cream cheese, let me know, reach out. But in simplistic math, it's a matter of what the economy is doing is what's driving these mortgage interest rates. When the economy is back to being good and stable, is a good word I'll use, then the mortgage rates are going to creep up there a little bit. We've got people going back to work. We've got the supply and the demand chains. We've got the volatility of really what's going to happen tomorrow. So when the economy is doing really good and great, the mortgage rates go up too. We can track this from 1971 historically to show that when inflation rates go up, so do the mortgage rates. Now, the good thing, remember, ask your parents, right? Ask your parents, ask your grandparents. What did they buy their home for? It was 15, 19, 20%. When I got in the business, they were 6.5%. And I was like, woo, it's mind blowing. So if we see an increase from, 3 to 3.5% that maybe we're seeing right now, or maybe even 4, that's still yielding a lower interest rate than what it did back 2019 and 2018. So just put that in mind. Know that if you're in the market to buy or sell or refinance right now, sellers, you're going to capitalize on the appreciation rate, right? So it's a fantastic time to refinance. We're going to use the equity of your property. We're going to consolidate that debt into one payment. I can't tell you how many consumers that we have loans through right now or have recently closed that we really have consolidated all of their credit card debt from when they have accumulated it over the past year. And then we're using the equity and we're allowing to use the equity and maybe the payment goes down. A lot of my clients right now are actually projecting for the future, right? I've got a senior, I've got to project for the future. So a lot of my clients are like, I don't know how I'm going to pay for college. So we're taking advantage of the interest rates today, even though they're yielding a little bit higher, to take that equity out of their property to project for the future. So squirreling back to inflation and mortgage rates. When you talk about the mortgage interest rates, they're really not set by anybody but the market, right? They're set on how is the economy doing. Now, remember, a 30-year mortgage is backed by the federal government on the 10-year treasury yield. Now, that 10-year treasury yield, if the yield is higher, then the rates are going to be higher. If the yield is down, then the rates are going to go down. So think about that when you're seeing those 1.9% interest rates. Well, know that that's just not happening, right? What we want to make sure you're aware of is when the cost of the good is up, mortgage rates are going to go up. Now, the difference of the 3.5%, or 4% interest rate may be only a difference of like $90, $100 a month. So it's not a big difference. But what is the big difference is what is going on? What is happening today to drive the market for tomorrow? And if your costs are going up, then the mortgage rates are going up. So again, inflation is set by they track them from the federal government at the consumer bank level to see where the spending habits are, right? When we talk about toilet paper, we couldn't get toilet paper forever. I can't get cream cheese. Bacon is up. You know, the cost of the goods are up. Milk is up. Bread's up. Chicken is down. So buy some chicken. That's right. Go buy some chicken. But when the boats are stuck on the outskirts 6 months ago, we have to think about the projection of the layers that it goes down, right? So it goes from the boat, we get them off the boat or from the farm, and then it goes to distribution. Distribution has to have drivers. Well, the problem is there's 40,000 drivers that are needed across the country right now because we can't get enough supplies into the local superstores. So they're sitting on shelves and distributions, and then those distributions are sitting on shelves in Florida, in California, on stacks and stacks and stacks. They can't get them to the consumer. So know that what you're doing today does ultimately affect of what's going to happen tomorrow. So just think about that, right? Think about what you're paying for today is the cost of the goods. And if your cost of your goods is up, inflation is going to be up. If the market is getting better because we're opening the economy, even though inventory is still down, the demand is so high and there's not enough supply, inflation is going to continue to rise. That means interest rates will continue to rise. That's just the way it is. Okay, so thanks for watching today. We're talking about interest rates, inflation, and I don't know, bacon and that's right, cream cheese. So we're so glad to have you each and every day. If you have any question on where the rates are going, what inflation's doing, how the 10-year treasury kind of yields into this, and what the heck is going on, hey, give us a call. And of course, if you're looking at refinancing or if you're looking at making that home purchase, give us a call. Let a family or friend know. Go ahead and share this video as well. We're always here to help. Of course, my information is below. You can also book a strategy session. Until next time, we look at helping you build your real estate investments.